The numbers are in, and the jobs report looked solid. Payrolls were up, unemployment ticked down. It's time to cue the confetti, right? Hold up. On this week's Wealthologist Weekly, we're going to dive into the cracks behind that so called strong labor market. All right, let's talk about the jobs report that everybody seems to be celebrating. 147,000 new jobs in June. Unemployment, it's down to 4.1%. Man, I got to tell you what, that sounds really good on the surface. But here's the reality. Underneath the headline, private payrolls, well, just 74,000. Government jobs accounted for nearly half of the gains. And when you strip out government, education, health services, and hospitality, which are heavily influenced by policy, you get what we call core payrolls. And that's just up by 3,000 jobs. And I got to tell you, that's the weakest numbers of the year. So, what does all of this tell us? Well, it says that the real economic momentum outside of Washington's spending influence, it's stalling. And even that dip in the unemployment rate, well, it wasn't from more people working. It was because 130,000 people left the labor force entirely. They're just out of there, which means fewer people looking. That equals lower unemployment rates. But also, it means a weaker job market. Now, here's the cherry on top. Wage growth came in at a mild 0.2% for the month. Now, that's 3.5% annualized, which sounds fine, but when inflation's been cooling, this is more evidence the Fed has done enough tightening. So, the question that a lot of folks are starting to wonder is why isn't the Fed cutting rates yet? I think that's a great question. Jerome Powell, the Federal Reserve Chairman, he's still saying not yet. But I got to tell you, at this point, I don't think the numbers are backing him up. Short term interest rates remain well above the Fed's own long term target of 3%. And inflation, it's showing signs of slowing further. And some now believe that politics might be playing a bit of a role in some of the decisions being made. Trump is, as we know, reportedly preparing to name Powell's replacement in advance of the 2026 transition. So markets may soon have two voices to listen to, Powell as well as his likely successor. Meanwhile, President Trump's One Big Beautiful Bill just made 2017's tax cuts permanent and extended some business friendly provisions. Now, for stability, that is a win. But the thing is, I don't think we should expect a Reagan style boom. Most of these tax rules, quite frankly, they were already in place and have been for quite a while. So what's the bottom line? Well, right now, manufacturing is barely growing. The labor force participation, it's shrinking. A core private sector job growth is barely positive, and monetary policy is still tighter than it probably needs to be. So while we're not in a recession yet, right now the markets aren't pricing in enough risk that one could be coming. So what should investors be looking at right now, and what should you be doing? First, don't let surface level data drive your strategy. Second, position yourself for uncertainty, but also stay grounded. And third, know the difference between jobs created by real growth and those propped up by policy. Now, maybe you want to talk about how to prepare your portfolio for the second half of 2025. We are always here to help. We love to help people cut through that noise and make those smart, lasting financial moves, regardless of what the media and politicians and everybody says. Now, my question for you is, do you think that it is time for the Fed to start cutting rates? Drop your take in the comments below. I'll weigh in during the next week's episode if some of that momentum changes. Also, please like, follow, and share this with someone that you think, well, might just think that the economy is just doing fine and might need a little bit of insight as to some of the numbers and what's going on behind the scenes. All right, as always, I'm Chris over at The Wealthologist. And until next time, stay sharp and stay curious. See you next week.